Hello and welcome to Moving Iron Podcast. This edition of the Moving Iron Podcast is brought to you by these great sponsors. Axon started out of a passion for keeping agriculture moving. Imagine having 100 years of tire and wheel knowledge in your back pocket the next time you sell a piece of ag equipment. To find more or become an Axon dealer, please visit axontire.com. This podcast is also brought to you by Valley Transportation. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 or go to valleytransinc.com for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. This podcast is also brought to you by Ag Direct. No matter how you buy your ag equipment, from a dealer, auction, or a private party, Ag Direct can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com.
Moving higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. And no matter how you buy ag equipment, from a dealer, an auction, or a private party, Ag Direct can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. This week, I've got a regular repeat guest on. I've got Rich Posson. Rich has got a podcast called Critical Point Podcast, and Rich has been on the podcast for about 4 years now, something like that. And he's been a wealth of knowledge when it comes to what's going on in the overall economy. And Rich, how you doing this morning?
Very good, Casey.
Why don't you tell the people about your podcast and what you've been doing over there?
Yes, you can find it at criticalpointpod.com. It has information about myself, the modeling analysis. There's links to go find videos, audios, some free, some is subscription-based. In the subscription, we discuss the economy from a business cycle point of view. We take a look at what's the largest trends for an entire decade of economic growth as well as economic destruction. And we break it down into short term so we kind of have guidance of where we're going month to month. And then we look at the stock market, have a very good model that's worked for decades here, quite profitable for me, and everyone's been working with me on it. And so we get quite detailed with that. We can even give daily updates, a weekly update, and then for long-term only, we have a monthly update. And then we have the grains. We look at gold a little bit. That's kind of just a secondary market for us. Bitcoin and crude oil and stuff like that, and interest rates are kind of a secondary thing. In other words, we're not necessarily giving alerts and signals on them. We're just giving analysis. But we actually give signals to kind of help with the trading, investing in the stock market and the grain markets, and even apply some of this technology to climate in the sense of trying to point out range of years where we're at risk for crop problems. We don't fine tune it. We leave that up to the weathermen to kind of point out whether the problem's developing or not, but at least gives us a guidance to look when there might be a problem.
Yeah. All right. So speaking of problems, there's a fair amount of stuff going on right now. If you take a look at what's going on in the news, you can't help but hear about, rocketing interest rates, inflation. We're doomed to go into a recession. All these things are moving along like you've talked about this, but you're more down the road. Like you're thinking more like 2030 before we really have a major hiccup. I guess as you go back and look at what's going on in your data now, what are you seeing as far as recession goes?
Yeah, I'm finding it difficult to buy into what's scaring at least some and Wall Street and even the public. And they call it the yield curve inverting. And what that simply means is short-term interest rates are moving up faster than the long-term interest rates. And they create a curve, and pretty soon the curve is just going inverted. And what they've learned is that's usually a sign of recession's coming. But the problem is they kind of advertise it like it works every time, and it does not. And in addition, it's a poor timing tool. Normally, a recession might not even hit to a year and a half out. Yes, there's been occurrences 6, 9, 10 months or something like that, but basically what they're looking at is some of them are already targeting early next year for recession. Well, that does not fit with the business cycles that I use, and these business cycles do very good at pointing out where's the most important recession. And it normally only occurs once a decade. It normally occurs near the end of a decade or the beginning of a decade. And granted, some people would say, well, we're still in the early part of a decade, but we've already seen that recession. That was the virus pandemic recession. Mm-hmm. So the best I can say, if maybe I could be somewhat right, and maybe they're going to be somewhat right, and we see some issues later this year, but I doubt, and on into next year, but I doubt it can turn into a true recession where the government's even going to say we are in a recession. The Federal Reserves would say that. And I must say, I've just developed something here in the past week where I take, instead of the spread of the short-term and long-term interest rate, I created a ratio, and I like that better than it fits in my model better. And you can see the ratio was just climbing, and it's just saying, yes, that 2-year interest rate is just rising much faster than the 30-year, maybe the 30 years even going down still. And I could see why they were getting nervous over that. But the fascinating thing is, just last week we made a forecast that it's possible that ratio is topped, therefore the inversion spread may have topped. Lo and behold, we come in this week and that ratio is down. And then we looked at, okay, what was the 2-year doing? Well, the 2-year was then dropping faster than the 30-year, the 10-year. And so to me, it's giving us a little sign of relief here that may not work, that it's currently, but this could be something that's on the table, off the table for a while. Suddenly it's inverted again and everybody's going to worry about a recession. And then a little while later it's not. And this could be a struggle. I think what occurred is these interest rates rallied so fast that it was just the short term going up too fast. Now the long term people dealing in that see the same thing. They're just saying, you know what? We got to recognize the fact the Federal Reserve is going to raise these rates. They're going to raise it several times for quite a while. And now what's going on is we got like a tide. Instead of a little wave coming across the ocean hitting the beach, we now actually got a tide coming in where all these interest rates are going to go up together. And if we can keep them going up together, that increases the odds of staying away from the inversion and therefore staying away from recession. And I think that's how it's all going to work. So I'm very concerned about these people forecasting recession. I think they're going to get people off on the wrong track. But that doesn't mean our economy won't slip a little bit, because the Federal Reserve has made it clear they are declaring war on inflation. They're not just trying to ease it back. They want to hammer it, okay? So they're warning us. They're willing to take the risk of taking this country into recession. This is almost like a miniature Paul Volcker moment back in 1980. When Volcker come in and said, this inflation is going to destroy us, and interest rates have been rising, but they're not rising fast enough, and we're going to use that interest rate as the weapon to kill inflation. And he did. He just threw the country right into recession. And President Reagan was, of course, not that pleased with it, but he understood, right, fortunately, what was really trying to be accomplished, and by golly, it worked. Well, Paul Volcker was hired to keep us from hyperinflation because we had inflation throughout the 70s. It was all every year, 5, 6, 7, 8% price increases year after year. The whole decade averaged like 7 or 8%. It was ridiculous. And the Federal Reserve woke up, hey, whatever we're doing here, this is not working. This system's going to blow up. And Paul Volcker was pretty much trained, educated how to deal with that. And that's why he basically became the head of the Fed. And he said, here's how we're going to do it. And we're coming out with guns blazing. And by golly, yes, we went into recession, but it really didn't kill the country. It wasn't the end of the world. This time around, I'm still convinced this decade is not the 1970s. It's more like somewheres between the 50s, 60s, and the 70s, meaning, you know, in the prior decade, the Federal Reserve couldn't even get interest rates up to their 2% target. Now it's way above their target, I think it's coming down to slightly above their target, about 3% average for this decade, I think is what's going to occur. They're not going to be able to get it back to 2%. They're probably always going to wonder why not. But I think they're also going to be cautious that if they ever drove it below 2%, then that increases the risk of going down to 0 or minus, and now we're in a recession. So I think they're going to be cautious here, trying not to cause a recession. But I don't think they're worried about slowing down the economy. I think they feel almost, again, like a miniature Paul Volcker moment is best here, that if we have to cool down the economy, do it and get that inflation down. So these rates are going to keep going higher, but I think the key is we need to watch those long-term rates versus the short-term. If we can keep them as a group moving higher, I think we're going to be all right. You're not going to get that inverted stuff that could suddenly cause some little crisis in the financial system. And then the next thing you know, it's hurting business and consumers, Mm-hmm. So I fully understand why some people are forecasting this stuff, but it just fascinates me, the amount of intelligent, very experienced people out there. It's almost like they dig too deep in the data. And even if they're broad-minded, it somehow makes them narrow-minded.
Right.
And it's like they forget the real business cycle. And the real business cycle for the history of this country, and I can even prove it goes back into England a long time before, we basically will build an economy for about a decade, and then, yes, something's going to fall apart, okay? And then we fix it. And these days, the falling part is brief compared to prior generations. We get it over with quickly. Creates a crashing moment, but we get it over quickly, and we rebuild quickly. Normally because we print money and pump it out there again. But I'm not saying that it's going to be a sweet ride all the way to near the end of this decade, and then we have a problem. And recently, I've had some people ask the right question to me, challenge me. Well, they'll say, listen, what if these people are calling for a 50% crash stock market? What if they're wrong? But what if the market fell a smaller amount where they could say they were somewhat right? Would that actually fit in my work where I could say I was also still somewhat right, that it just wasn't devastating enough, And I will say, yes, we have to be concerned through this decade, the stock market can drop 20%. That's normal fluctuation during a boom period, but it doesn't happen that often. And we just went through one, okay? The NASDAQ stock index fell, 22% or more. I think the Russell 2000 was down 27%. The S&P was only down 16%, but good enough in my opinion, okay? So, the way I look at it, the stock market is probably going higher into 2024. And then I do see some issues, 2024, 2027, somewhere's in there. I do think commodities can come down quite a bit by then. Mm-hmm. I think real estate can back off quite a bit. Therefore, probably inflation's coming down quite a bit by then. But I don't see this war on inflation causing issues from now into 2024. I think there'll just be little hiccups, speed bumps, hurdles, some headwinds at times, hold us back. Yes, little drops in the stock market, and we may worry over it, but it's fascinating when you look at especially the stock market, when it does these decade-long bull markets, it's fascinating how many people worried throughout the entire bull market, and they lagged. And speaking of worrying, if you look at the University of Michigan consumer sentiment, and I got a chart up in front of me here to remind me just what it's doing, the sentiment rating is below 65. Can't read my chart here. It's probably like 63. And consumers back in 2017, going into 2018, were like 100 in that index. Yeah. Okay. So big change. So what happened is the virus pandemic come in and just hammered that from the 100 down to about 71, it looks like. And then we recovered, okay, on up to about 88. And now here it is, 65. The consumer is more pessimistic today than they were back during the pandemic virus, right? Yet the economy today is record large. If we put a dollar amount on it, our economy is worth the most ever. If we put a volume on it, it's the biggest, largest economy we've had ever. So we have recovered. We did beat the recession. We are moving. So why is the consumer so pessimistic? Well, the biggest answer is the consumer's watching prices go up in the store, and they're just saying this is not good. Okay. The interesting thing, though, is when you look at what they're doing on their credit card, they've spent record amounts. Now, of course, some of that is because of inflation. Everything's more expensive. But the point is they're not cutting back. There's no evidence of them cutting back. If you find evidence, they're saying, well, I'm not buying this product as much as I used to. But you find out they're actually just replacing that with something else. Okay. So at the moment, the consumer's thinking this is not good for the future. And they may be saying that or saying a little something different, but when you see what they're doing, they're not doing what they're talking about. Well, I went back and looked at the financial crisis in 2008, 2009, and from 2009 bottom, you could see the consumer started to get a little more optimistic and then turned pessimistic. And by 2012, they were just as pessimistic as during the financial crisis. I remember the Bank of America Merrill Lynch had an index showing the retail investor in the stock market was actually more negative the stock market than during the crash in 2008, 2009. And they were wrong. So that got me digging, going back all the way back into the 1950s. And I found that's not a regular pattern, doesn't happen that often. But I found similar patterns where people, they see the recession, they see a little bit of a rebound, and then they get nervous. Yeah, but that's a fake out. It's not going to work. This country's still got problems. And they worry that it's just everything's going right back down again. And here we are. We're seeing that same story. So my forecast is we're stretching rubber band. The consumer is wrong now. And by next year, I'm very convinced the consumer is going to be much more optimistic. And I think they're going to miss out if they think the stock market's just going to keep falling. I'm not saying it won't fall over the next few weeks here. My stock market model is warning a little bit of that. But I don't think this is going to turn into a crashing moment. I think what's going to happen is, I don't think these interest rates are really going to blow us up, send us into a recession. And even in the stock market, we're finding evidence that, maybe the consumer is saying, boy, I'm nervous over the future. They're still investing in the stock market. They're buying this stock market, and they're just trying to hold on it, wait it out. So, my game plan here is the consumer will be in a better mood next year. I said back at the end of last year that I felt like this year's stock market may only be up a little bit. I think I said 5, 7, 9%, but I said I can't rule out something grand like 20%, but I said I think it's just going to be up some. And the reason was I knew it could be down. And then when I saw it down this 16 to 26% or whatever, I said, okay, we got a long ways to put it back up. I'm probably going to be right on that 5, 7, 9%. So back late last year, I also said 2023 ought to be the great year for the stock market. I think we're going to have some good profits in the stock market. So I realize I'm going against some of these guys talking crash and recession, but it's not adding up yet. And I look at their track record to mine, and I'm saying, I'm sorry, I got to stick with my track record. Let my model run. Now that doesn't mean I'm so bold that I'm fully invested in the stock market, and when I'm fully invested, I'm actually like 200%. So I'm far more aggressive than most people. But I always manage my risk. I mean, I have sell stops. If the market goes down a little bit, I'm out, and I got to start over. So I don't want to be an idiot about this at some point. And the market at some point proves us all an idiot for a little while at times. We all have to admit to that and realize that, But I must say, I think this economy is actually on track quite well. I think the model was warning this year, we're going to hit speed bumps, hurdles, but we're going to deal with it. We're going to work through it. And I do think these interest rates are going to march higher anyways, but I'm really hopeful now. I'm really excited about this new study that relates to that spread study of the inversion. I'm forecasting it's not going to be that much of a problem. And I'm going to stick with my plan that we're not going to go into a recession. But again, we may have some scares along the way too. And we certainly know we have the headwinds because inflation is there. By the way, on inflation, the used car prices have crashed on a rate of change basis here. I didn't remember to put my chart up here so I can give you actual numbers on it. But Wall Street was taking a look at that this week. It was in the headlines, the buzz columns, and Twitter and all that. And we're seeing a few other things break lower. Even egg prices moved up from January to just a few weeks ago. Now they're rolling over. Well, you could argue seasonally, they normally do that. They like to run the prices higher up towards Easter, and sometimes they start down just as you get in Easter. They're kind of doing it again. But the point is they can be lower later in the year. And so to me, this whole inflation stuff is starting to break up. We're going to start seeing some softer commodity prices. By no means do I think anything's going to crash here, like over in the grain markets. We know, the old crop supplies are very tight. We still got good demand. We got the Russia-Ukraine stuff causing issues. So we're not going to see a crash in grains that's then going to crash the inflation rate. And grains are just one component of all that inflation. But I am thinking that some of these big ticket items and home prices, I got friends calling me up from other states saying, are you building a home? And I said, yeah, I'm trying to build a home, but prices have shot up. Well, boy, some of them are reporting that it cost them double today of what it would have a year ago. And many of them are saying, I got one friend is saying, well, I built a garage with an apartment. I'm living in it for a few years and then I'm going to build my home. I'm going to take a chance. And he's admitted, maybe he's going to wind up paying even higher, but he says, boy, this jump was just breathtaking. Got to take a chance to wait, And I think these interest rates will curb the real estate here a little bit. We're kind of seeing a little bit, but on the other hand, there's two types of people. One is they're looking at rising interest rates and saying, but I better still buy that home and I have to pay top dollar. I better do it because the rates are just going to keep going higher. And then the other half are saying, you know what? These rising rates ought to make things cheaper. Even if not, things are just too expensive and they are backing off. I think it's going to take a while to get the majority saying, I can wait. I just have to back off here. But so this war on inflation is going to work. It's just a matter, are we going to fall into a recession to really help that or not? And as of this morning, I'm saying we're not going to go into a recession.
Right. Do you think some of this economy scare that you're seeing is so like on the equipment side of the business right now? If you have a tractor that we can go out and sell, a used tractor you can go out and sell, or a new one for that matter, you're going to get a premium for it, right? Because you're probably the only one that has it, right? If it's physically for sale today and you can physically take it home today and go do it. Do you think some of this economy scare that people are talking about is that clearing of some of that premium across the board, whether it's commodities, whether it's, we're short on grain, we're short on cattle, we're short on hogs. If you look at the number of animals out there and the amount of grain out there and what's going on with Russia and Ukraine, even extrapolates that even more. And then you start looking at, shortages coming out of factories and those kind of things. When factories get back online and everyone's, 100% production is the way it's supposed to be and there's no more delays because they're missing a bearing or whatever might be causing the problem. Do you think some of that economy scare is just we're knocking off that 25% premium that's laying out there or whatever the number is, and we're going to go back to some more of a normal level of pricing and availability?
I do. But I'm finding it difficult how to time it and how long, because even the supply chain, I thought it'd be over by late last year, and here we are. Yep. It's improving. We're going to get there, and I think we're going to get there this year. But it isn't moving fast enough for some people. I can see that. But I think that's what's going to happen is you got to take the premium out. I don't think we're going to see prices go back to where they were a couple of years ago. I think it's a long ways down the road. Home prices aren't going to fully collapse to where they were by no means. We've done something. We're taking prices, and you can see this. We do this about every other decade, and this is the decade to do it. It was every other decade. We kind of shove everything up, then we ease it back some, but seldom do we take it all the way back to the bottom. Right. So it's kind of like walking up a stairs, and we'll do it again in a couple of decades. We'll have another one of these for some reason where we're going to jump everything up. But I do think everything's too rich on this whole pricing thing, and we'll ease it back. And that's why the inflation, depending on what indicator you're using, it's anywhere from 5% to 10%. I think the one most people watch probably is CPI, and what's that came in this week, 8.5% or something like that. Yep. Yeah, I think in the next few years, they're going to walk that down to about 3, but I don't think we're going back to 2 this decade. If we do, it'll kind of be a brief moment, 2, 1. Next thing you know, you're back to 3 to 4, something like that. Now, at the end of this decade, we get that primary recession, that once a decade sell signal I get. Yeah, I would be surprised if inflation goes back to 0, maybe even minus. But that's because of the more important recession during the decade. And not convinced we'll see inflation go that low from now until then, But I think we're going to walk it down. I'm very confident we're peaking inflation this year. Mm-hmm. So I think prices ease back. It's just some things may not. When you look at the individual items on the list, some things may not actually start down to next year. Some things have already started down, and then some things are going to start down this year. But I think as you put it as an aggregate and come up with that inflation number, my guess is we're looking at the highest inflation this year. Mm-hmm. And some people are already gambling that we just saw it in that March report, but I don't have anything to fine tune it. For all I know, it can go higher into summer, then down. And I think that's what the Federal Reserve is betting on. Also, I think the Federal Reserve is betting that if they talk really serious about this, because they're already swinging back to saying we're going to do double increments, or at least they're saying they could, of course. I think they're trying to get the free market to do the job for them. And the free market is already way ahead, of my opinion, of the Federal Reserve rate hikes. But I think what they're hoping is the free market system will get rate hikes enough, cool the economy down, start to cool down inflation. And then the Fed, even although they will still raise quite a bit, they won't have to keep pushing it. Okay. Mm-hmm. And that's my gut feeling, is they're hopeful that they're talking and getting started on raising rates is going to help trickle through the system here. And then we, the consumers and businesses, are going to change it and bring the inflation down. And I hope that's actually what we do, because I really don't want the Fed raising their rate to 5%, because I can tell you commodities are going to be in the toilet right along with everything else. Right. I don't. 5% is not good for me. And I want to be cautious saying it in the sense I'm not so sure there's a magical number. I'm normally just concerned how fast they raise rates. And a couple of weeks ago, we saw a surge in interest rates, and the NASDAQ stock index that people normally say falls apart on higher interest rates. It does not like higher interest rates. I must say, boy, they surged those rates and people bought those NASDAQ stocks. And I thought, wow, even I'm surprised at this, Mm-hmm. And I'm already bullish on stocks, but I said, I'm surprised at that. But I will say this week, we saw some selling in the stock market here as they put rates higher. And the surge really wasn't as fast. So I'm getting concerned. Even the stock market is a little sensitive to rates right now, and that's going to come and go. Okay, but again, at least going into summer, I don't think we're going to push anything high enough to really trigger that recession. Hopefully, what's going to happen is we're going to start walking prices down a bit, cool things off a little bit, but the economy will continue to grow. And I think the stock market will pick up on that. It may not be a robust market, but I don't think it's going to fall apart. So.
Right on. Okay. All right. I want your reaction to this. I think it was last week, Janet Yellen made a forward statement, basically to China, saying, hey, if you guys invade Taiwan, the same things are happening with Russia as far as sanctions go, we're going to do the exact same thing with you. So you might want to think about that before you go do that. And, the market didn't really, there's a blip on the radar. No one really saw much of it, but that's a pretty bold statement, especially when you talk about a trade partner like that with China that we have, not from the agricultural side of the business as well as the manufacturing side of the business. So I guess, what's your thoughts on that? Say we had China moves on Taiwan, and we see the same level of sanctions that we saw get levied to Russia, get levied to China. It's going to have a different. Don't get me wrong, Russia's got a lot of oil that we get pumped back out into the world supply, but it's a different thing with China. So when you look at that, what's your thoughts there, and what kind of impact would you see that having on the overall economy?
Yeah, even 2 or 3 years ago when I said, boy, I'm very bullish this decade, but I said one of the things that might be difficult for me to keep up with and can create some hurdles here and some fast drops in, say, the stock market and throttle back an economy is geopolitical issues. And back then, I was thinking more of just as China and any trade wars and the Asian nations. But I knew we could have issues over in Europe, Russia, Middle East as well. But now, of course, we know Russia, Ukraine's on the list. And I think with China, on one hand, I'm glad to see that we stepped up and said that, because to me, it's sad to see the size of Russia, the size of China wanting to take over other countries, smaller countries. In this day and age, we ought to be better than this. We ought to be more civilized, modern. I mean, it's just, it made sense 500 years ago. Today, I don't get it. I mean, what are you really that threatened? Is China really that nervous over Taiwan? Is it really that greedy that it needs it? I mean, their economy is so much more bigger, and I think the world has to come together saying, look, whatever the countries we have today, whatever's on that list is staying on that list. You go take over another country, we're coming after you. We're just not going to tolerate it. So granted, I hate to see, I love my stock market and I love making money. And it's at the same time, I'm willing to have problems over that kind of issue. Now, the key is how serious the problem. And I must say, I think a battle with China is probably going to upset our economy more and our stock market more than, say, with Russia. Okay, if you look at the Russia-Ukraine event and the way I look at it, where that story really hit, all it was a decline for 1 to 2 weeks that brought the S&P 500 down to near the low of the year. Couldn't even take it any lower. Now, the NASDAQ went a little lower, but that also was a time of some interest rates too. And we're hovering above it, even while this Russia-Ukraine thing is going on. And this Russia-Ukraine thing can go on for months yet. It could be all year trying to fix that and resolve it. But to me, the China's a big one because we have so much export business there, and then China's big in relations all over the world. We have to be looking over our shoulder at that. How can that interfere with our commodities and stock market? Today, I don't see it, but I think probably the U.S. made the right statement here and not wait on that. Okay, they easily could have just focused on Russia, Ukraine, and not tried to upset China. And so I'm glad they made the statement, frankly, and because it just does not make sense to me to do it. And I'm just puzzled why some of these nations get into those kind of attitudes, and sad state of affairs. But at least today, I'm not dialing anything great, but there's no way I can tell. I mean, if somebody's going to touch off a nuclear bomb over some of this stuff, I very doubt my model's going to predict that. So,
you don't have that built in
no,
there, huh?
I think that's where the stops come in. But the problem is when governments do this, they tend to do it over weekends and nights. And so it's like you and I are screwed when we walk in the next morning. I mean, it's like commodities are going to be down, stocks going to be down, and you're not going to do much about it. So
that's very true.
Yep.
Very true. All right. So from a world economy standpoint, though, I mean, if we stop taking manufactured goods from China, and obviously the grain thing, there's only so much grain in the world, right? So I mean, they're gonna whatever grain they don't take from us, they'll find someplace else, and whoever's taking that grain, whoever has sold that grain to China is going to be buying that from us. I mean, right? So it's just a big circle. Right? I mean, it's going to take some while to get that circle going, but from the manufacturing side, if the U.S. just says we're no longer taking any manufactured goods from China, period, the end, no more imports from China, that's got to be a bigger deal for China than it would be for the U.S.
I would think so. Our economy is still bigger, in my opinion. It's far more mature how we handle it. Thankfully, our dollar is still valuable enough. If we need to print money, there's probably someone else in the world that's going to take some of that as well. And that allows us to get away more with other countries, gives us a better cushion. I agree with that statement.
Okay, right on. Well, Rich, I could go on for hours with you, man, but unfortunately, we can't do that. So as you, one last thought here, as you take a look at what's going on through the end of this year, going into 2023, what do you think is going to happen? What's your overall picture here?
Yeah, I think, let me start with the stock market. The S&P 500, I think by summer can be back up in the 4,700 area. I'd love to see it at record high, which probably means, I can't even remember the record high. It's probably got to go over 4,800 or something. But I do see somewhat upside, might see some issues around September and October that are normally soft months of the year. But I think looking out to the end of the year, stock market will be doing fairly well next year, much better. Interest rates, boy, what we were knocking on the door of 2.9 here. I think we can get into the 3% area as we look over throughout the year here. We may see 3.5, 3.7. On the 10-year note, mortgages are already over 5%. Haven't seen that since 2010 or something. Yeah. They're probably going to work a little higher too. But again, I don't see those levels as triggering something wrong here. I think the GDP by the end of the year will pull off some, but not by tremendous amounts. I think the inflation is going to be down some, but gosh, it's a wild card. Let's see, we're 8.5 now. If it has topped out, I wouldn't be surprised it eases back 6 to something like that by the end of the year. I'd love to think 5, but that may be pushing it. I think next year and years after is the better time to get it down to 3.5, 3. I think that's a good, comfortable level. That's still higher than the prior decade, but I'm fine with that. I can live with it. Whereas right at the moment, we're frothy. Everything's too rich and too expensive. And so I think we'll ease that back. Commodities, some of these, I think they've already topped, going to ease back in the end of the year. But like grains, I think we're actually going to pop these grains into May, and corn might very well be the leader of that. Then we're going to have to wonder, are we going to get a crop problem this year or not? I'm favoring next year, but boy, I'm leaving the door open. I look at that drought monitor map and I'm saying, boy, it can be this year. And even my model is saying 80% chance of lower yield. But at the same time, it's saying it's probably only going to be a couple bushel lower. So I don't think this is the year for the crop problem. So I think we'll be backing off the grains into harvest, but I don't see a major drop. It's going to take a while to rebuild these supplies. We don't know yet for sure how much Ukraine can grow and produce. And even Russia, even if they're maximum production, with sanctions in the rest of the world, how well are they going to ship it? So, I can see bearishness going into fall months off the grains, but I'm not convinced it's any kind of major collapse anytime soon here. What else have I got for you? The PMIs, which give us an indication of manufacturing, services, industries, and a clue for GDP and how the economy is doing. Yes, they can get sloppy on me going into summer, primarily because we're fighting the inflation. But I'm very convinced next year, if not later this year, I think we'll see some improvement in the PMIs, and therefore the economy will finish out okay at the end of the year. That's how I look at it. I think, we've had struggles and headwinds from January to now. We might have a couple more months, but I think the latter half of this year, we're going to get some things resolved here well enough that we'll see, you know what, the economy is still going to do okay going into year end, and the stock market will be working a little higher. And even if commodities are going down into the fall months, not a major collapse or anything like that. And model's been doing very good short term in crude oil, and it's kind of favoring a little backing off next week, up the following week, kind of zigzagging. I would love to see it ease back into May. I think oil is only worth $90, so it is a little overvalued, overpriced here. So I don't think it's going to rush higher like some are still forecasting. I think that's going to stall out for us, I hope. And we'll just see. We'll take it one step at a time. And gasoline demand's already backing off. But normally how they would do it is they might give us a little price break in the summer, but not anything major. You usually have to wait till you get into the fall months for that. So, I'm optimistic and basically bullish most stuff here, but we do have the geopolitical issues that we have to keep an eye on, and crop-wise, we've got to watch the weather that can now change week to week, day to day. And there's going to be, it'll fluctuate. Everything's going to fluctuate. But I'm not on board with those who are trying to paint a pessimistic picture for this year. We'll get through this somehow, some way. And 2 thumbs up for next year is better times.
Right on. All right, Rich. Good stuff, man. Love having you on here once a month to talk about what's going on in the economy. Tell everybody where they can find your podcast at.
Okay, you can go to criticalpointpod.com and you'll see some tabs up top where you can go to a page that shows just the videos, audios. You can even subscribe there, but there's also a subscriber page on the homepage. But we do put out some free stuff so you can get some ideas of what we're doing. And at the website, there's explanation of who I am, what am I doing, what are these business cycle models all about. I look at some short-term stuff, all the very long-term stuff of where we think the economy is going next 20 years even. So take a look at that, and you can follow me on Twitter. You can also ping me, DM me on Twitter. I'll answer your questions and whatnot. And my address for that is at Rich_Posson, Posson.
Right on. Make sure you follow him on Twitter. A lot of good stuff comes out there, Rich. Appreciate you being on the podcast, man.
Thank you very much.
I am Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you find the latest editions of the Moving Iron Podcast. Also, check out my LinkedIn page. There's a lot of information gets posted there. Just posted a new blog. It's out there on LinkedIn. And also go to my website at MovingIronLLC.com. That's where you find the blog posts as well as all the Moving Iron Podcasts. The library of Moving Iron Podcasts are there. Also get all the information for the Moving Iron Summit coming up here in Nashville, Tennessee, September 6th, 7th, and 8th. Rich is going to be a speaker there. He's going to be talking about what's going on in the economy as we head into 2023. So with that, I'm Casey Seymour with Rich Posson. Let's go smart, folks. Out. Axon Tire is going to have more tips, tricks, and client advice throughout the year and in September at the Moving Iron Summit in Nashville. If you're looking to sign up for the event, please head over to MovingIronLLC.com. We hope to see you there. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 or go to valleytransitinc.com for all of your trucking needs. At Valley Transportation, our goal is to help you reach yours. And no matter how you buy ag equipment from a dealer, auction, or a private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com.
Moving higher in the 21st century.